Okay, we are back with another one. Last week, we gave y'all a breakdown from two videos. We gave y'all one stock 101, just explaining what a stock versus stock option is. And the last video we had uploaded was simply about stock option calls. Today, we're going to deep dive and focus more onto put option calls. And if you don't want to know what a call and a put is, you need to go watch video number 1. That simply tells me you're interested in what I'm talking about and you're very intrigued in where it's going and how it can benefit you, but yet you haven't done your own personal research. That's okay. There's nothing wrong with that. We'll get to that. That's what I'm here for. That's what the Prolific Learners Network is here for that. So today we're going to be deep diving into put options call. So what is a put option? A put option is a financial contract that gives the buyer the right, but not the obligation. Pause. You know I put these notes well together for y'all. Please. I don't ask you to fund me. I simply ask you to support me. Please just hit the like, subscribe, and notifications button, and then come back and just listen to the video and implement it into your everyday life. Now back on track. A put option contract is a put option is a financial contract that gives the buyer the right but not the obligation to sell a specific asset such as a stock at a predetermined price called the strike price before the option expires. Put options are versatile tools used by investors for several purposes, including hedging and risk management. Boy, I think I messed up my notes on that one. Cool. How put option works. Okay, here's how put options work. You got the strike price, the expiration date, the premium, and the contract size. Sounds familiar, right? Sounds just like a call option. The only difference between a call and a put is you believe if you do a call that the market is going up. If you do a put, you believe the market is going down. That's as simple and plain and simple as it can get. Calls going up, put down. Okay. A strike price. The price at which the buyer of the put option has the right to sell the underlying asset. The put becomes more valuable as the asset price declines below the strike price. Expiration date. The date by which the option must be exercised or it expires worthless once the expiration date passes. But the put option can no longer be exercised. I don't think but was supposed to be typed right there. Now to the premium. The price the buyer pays for the put option. This is the maximum amount the buyer can lose if the option expires worthless. Contract size. Typically, one of the option contracts represent 100 shares of the underlying asset. I told you, anytime you're doing options, specifically options, is gonna be for 100 shares. That's the only way you can do option. You can't do an option contract for 5 shares, 10 shares. It has to be 100, which is why whatever the strike price is, you want to or not the strike price, which is why the premium, whatever the premium price is, whatever you have to pay for the premium, if it's a 1.00, you have to multiply that times 100. So that's $100. If it's 9.00, you multiply that times 100. That's $900. If it's 10, that's $1,000. So on and so forth. You get the picture. Okay, continuing. Okay, I even put an example of how put option works down for you. Imagine you purchase a put option for a stock currently trading at $50 with a strike price of $45 and an expiration date 1 month from now. If the stock price falls to $40, the put option allows you to sell the stock at $45 above the market price, locking in profit. That's how you make your money on both calls and puts. If the stock stays above the 45 strike price, the put option expires worthless and you lose only the premium you paid. That means the expiration date has came, it has not exceeded your price that you targeted for, and therefore it is worthless once that happens. That's why for someone like me, we do leap option and long-term investments. It needs to be 6 months to a year out, and that gives us time. Mind you, I am not the person for put options. I'm more so the call guy. I've done puts, but I've made way more money on calls than I have puts. Okay, going into why investors use put options. Hedging and risk management, speculating on declining prices, management portfolio risk, locking in profits. Now, we're going to break all that down for you. Starting with hedging and risk management. Take me a little sip of my drinky drink. That's the Hulk. You got to let the Hulk get up in you and then let him out through your investments. Don't get it confused. One of the most common reasons investors buy put options is to hedge against a decline in the price of a stock or portfolio they already own. By purchasing a put option, an investor can ensure their profits and protection against potential losses if the market or stock price fall. Giving you an example again. Suppose you own 100 shares of a stock trading at $100, but you fear the stock may drop in the short term. You can buy a put option with a strike price of $95. The price is at $100. You think it's going to come down. You can buy a contract with a strike price at $95. If the stock falls to $85, you have the right to sell it at even $95, limiting your loss. Speculation on declining prices. Put options also allow investors to profit from a decline in the price of a stock without having to sell short. I put in parentheses. Borrow shares to sell or back. Borrow shares to sell and buy back later at a lower price. That's what hedge fund managers do. When the stock goes up, once it hit a 52-week high, a lot of hedge fund managers will sell their position, which will cause it to come down. And a lot of retail investors, if you're smart, you'll take profit when it hits this 52-week high. Now, when it comes down, that's how we're explaining that if you have a put option, that's where you win. Because it has to come down. When they're selling off, they're trying to sell off where their top 52-week high is. They'll sell off for a profit. They'll take their profits and the strike price will come down. When the strike price falls below a certain percentage, typically 20 or 25, 50 or 75%, as long as the fundamentals haven't changed, as long as the fundamentals haven't changed, those same people, retail investors or hedge fund managers who sold when it was at a high, will wait for it to come down a certain percentage and buy in at a lower price. Back to the example. And I'm going to start back over because I done went over here with it. An investor believes a stock currently trading at $100 is overvalued and will drop in a price over the next month. The investor buys a put option with a strike price of $90. If the stock drops to $80, the investor can sell it at $90, making a profit on the decline. This is known as a bearish strategy, where the investor expects the underlying asset price to fall, meaning you don't have great hope in what this company said they're going to do. Mind you, this is a side note. A company has to tell you every year at the top of the year, their fiscal year, what they're going to do throughout the year. They have 4 periods of earnings. So every 3 months they have earnings. They have normally an earnings date where they have to release their financials, income, cash flow, and balance sheet statements, and they have to give guidance on what the next 3 months looking like. Mind you, at the beginning of the year, they have to lay out guidance for the whole 12 months. So I look at it like this. If you're going to tell me at the top of the year what you want to do with your life, and you get 12 months this year to work on that, and I notice in the first 3 months, you're bullshitting, you ain't working on what you said you was going to work on, why would I invest my money with you? It's that simple. Why would I invest my money with you? Now flip it. Say you are working towards what you might not be where you want to be, but you are working towards it. And I believe in you. I can now invest my money with this company. And when you do achieve what you said you was going to achieve, we both benefit from it. You get where I'm going here? You feel what I'm feeling? We family. You see what I'm seeing? Let's continue. Management portfolio risk. Put options can be used to create more complex portfolio strategies that balance risk and reward. For example, an investor might buy a put option to protect against a downside risk while still holding stocks for potential upside risk. Protective puts and portfolio insurance. A strategy and this is for protective puts. Protective puts, a strategy where an investor buys a put option for a stock they already own to protect against a decline in the stock price. That means you're making money on both ways. You bet for long term is going up, but the market is pulling back. Economic data is bad, which causing the market to go down. The Fed's tripping. That might make the market go down. Okay, cool. So in order to offset your losses or to hedge your portfolio, you'll do a put option. Even though you believe the market is going up, but because of all the current data that's going on, which pulling the market down, you'll do a put. Cool. Yeah, where was I? A strategy where an investor buys a put option for a stock they already own to protect against the decline in the stock price. It works like insurance. If the stock drops, the losses on the stock are offset by the gains on the put option. Portfolio insurance. Investors may buy put options on market indexes such as the S&P 500, DIA, which is the Dow, and QQQ, which is the NASDAQ. And that's not even in my notes. That's just off the top of my head. To protect their entire portfolio against a market downturn. If the broader market falls, the value of the index put option rises, helping to reduce overall portfolio losses. God damn, I'm good at what I do. God damn, I'm good at what I do. Man, let the hawk come out real quick. Okay. This is going to be one of those important ones. And this is what I'm going to stress to people. Locking in profits and losses. When you're up 50, 20, 50, and 100%, please take your profits. Don't get greedy. I want to see 200%. I want to see 300%. I want to see that motherfucker hit 1,000%. Don't get greedy. Take your profits. Same with losses. You do not win and be able to take profits until you lock it in. You cannot lose your money unless you lock the loss in. Meaning, I'm just giving a quick off the top example. I buy a contract for $100. The minute I go ahead and enter my order, let's say it dropped down from $100 to $95. I've seen people get so scared of losing their money, they immediately take it out. Not understanding you still have time on your side. Had you just let that be for another day or so, because it'll drop $5 today and it'll shoot up $10 tomorrow. It'll shoot up $10 today and it'll drop $10 tomorrow. You don't know what the market is going to do, which is why you want to buy time. Do not day trade unless you know what the fuck you doing with a team. Please do not swing trade unless you know what the hell you're doing with a team. Preferably speaking, and if I'm going to refer you to do either or, go to Aristotle's Honey Drip. You want to do day or swing? Go over there to Aristotle. He can help you. Me personally, I just find more value in leap and long term. So I will take my ass over there to Earn Your Leisure and Wall Street Trapper. Key components that affect put option prices. The price of a put option or its premium is influenced by several factors: intrinsic value, time value, volatility, and interest rates and dividends. So you got 4 factors. We're going to break down all 4 of them. Watch me. Intrinsic value. Goddamn, sit up for you. Let the hawk in real quick. Intrinsic value. The intrinsic value of a put option is the difference between the strike price and the current price of the underlying stock, but only if the stock price is below the strike price. If the stock is trading above the strike price, the put has no intrinsic value. It is OTM, which is out of the money. We'll go over out of the money, in the money, and at the money in a whole different video. This is not for that. Today we're deep diving into put options. Time pause. My apologies. I even wrote down a formula for you guys. The formula to figure out intrinsic value. Intrinsic value equals strike price minus current stock price. Formula for intrinsic value. Intrinsic value equals strike price minus current stock price. You know. Now that you know, it is your fault based on how you choose to implement it. Cool. Time value. The time value is the extra premium that an investor is willing to pay for the possibility that the stock price will drop before the options expire. The longer the time to expiration, the higher the time value, since there's more time for the stock price to move in the desired direction. That's why I tell you guys to buy fucking time and do not just hop into this. A lot of people just hop into this not knowing you're going to end up losing money if you do not know what you're doing. Ask me how I know. The reason I know, because I was one of them people. Just as much money as you're going to see me make, I'll show you my losses. Sometimes losses aren't good. I can't tell you what to do when losses happen. That's called emotional development. You have to develop the emotions and the wherewithal to get through that. You have to build the emotional fortitude to even stand with losses. When people get discouraged from those things, carry on. Volatility. Volatility measures the price fluctuation of the stock. The higher the volatility, the more likely it is that the stock price will move significantly, increasing the potential value of the put option. Therefore, options on volatile stocks tend to have higher premiums. This is very true. If this stock normally runs $10, Tesla, Nvidia, AMD, ARM, A lot of these stocks that I just named, they're very volatile. Volatility means they might run up $10 in a day, might drop down $5 the next day, run up $15 the next day, drop $9 the next day, run up $30 the next day, drop $24 the next day. So because they move in such big bulk up and down, you're gonna pay a higher premium for them. Which if you want to know how volatile it is, look at the beta. Now we're gonna explain the Greeks in a whole nother video, but the beta will tell you how volatile a price can move. The higher the beta, the more volatile the price is. Interest rates and dividends. Interest rates and dividends can have a smaller secondary impact on a put option price. When interest rates rise, put options tend to decrease slightly because the cost of holding stocks is higher, making puts less necessary as insurance. Now, I put down, let me see. Okay, cool. We're moving into number 4, which is put option strategy. Now, you have, for put option strategies, you have long puts, protective puts, put spreads, cash secured puts. Those are your top 4. And I put down an example for at least 2 to 3 of these. We're going to start with long puts. Long puts, the simplest strategy of them all, is buying a put option long put, which is a bearish bet. Bulls are just like calls. They think you're going up. Bears are just like puts. They think the market is going down. So when you hear bear or bull, a bear just saying they think the market is downward, bear, because they swipe down with their claws. Just, again, go read the fucking books. That's how I learned it. They swipe down with the claws. Cool, that's how they got that shit. And a bull, when it's charging at you, it's coming upward. Like, boom. Cool. That's why they feel the shit will go up. So when you hear bears and bulls, it's just calls and puts, which is up and down. Long puts. Buying a put option long put, which is a bearish bet. The investors believe the stock price will fall and they profit if the stock declines below the strike price. Protective puts. In this strategy, the investor owns the underlying stock and buys a put option to protect against downside risk. This is often used as a form of insurance. Example, if you own a stock at $100 and are concerned it may drop, buying a put option with a strike price of 95 can limit your downside, as you can sell the stock at 95 even if it drops below that. Meaning, your long-term buy and hold, you got it at $100. But you see how it's moving and it's just dropping down. You think that it's going to pull back down to 95. Okay, to offset that little bullshit $5 difference, you can pay a little extra money for a premium put option contract. And when it goes down, you actually make money from it going down, which is offsetting that $5 that you're losing from your initial investment. I'll do all these videos one day showing firsthand how it looks. Right now, we're just going over everything as far as the method and helping you and me understand on better terms how this stuff works. We're going to move on to put spreads. Got to let the hawk in. Put spreads. A bear put spread involves buying one put option and selling another put option with a lower strike price. This strategy reduces the cost of puts. This strategy reduces the cost of the put, but also limits the potential profit. I wrote that right. Example, you buy a put option with a strike price of 50 and sell a put with a strike price of 45. This reduces the premium you pay, but your profit is capped if the stock drops below 45. Cash secured puts. Now, I'm going to repeat myself before I continue. I don't do puts. I understand them. They just don't work best for me in my strategy. I didn't say they didn't work. I didn't say it didn't work at all. I didn't say it was bull. They work. You can make money off the market going down, but the market goes up 79% more than it goes down. So if I'm going to do long-term 6 months, 12-month options, I'm going to do calls only. The worst 2 months in the market is September and fairly August, September, and October and November typically rebounds. Now, if I'm gonna do a put, it'll be a swing or a day or some shit on like in that month, and it gotta be that bad economic data. Otherwise, I play around with puts. I don't like it the way I've broke even more times than win or lost money on puts. I really haven't ever. One time I've lost on leap options. And when I say lost, meaning it dropped down 60% and the fundamentals changed in the company, and I was just like, you know what, let me lock my loss in. I'll take whatever my money is that's left, take my shit back, and reinvest somewhere else. But I only did that because the fundamentals of the company had changed. The fundamentals of the economic data had changed. So that's when I was like, you know what? Get up out of there. We're going to continue. Cash secured puts. A cash secured put involves selling a put option while setting aside enough cash to purchase the stock if the put option is exercised. This strategy is used by investors who are willing to buy the stock at the strike price but wants to earn a premium in the meantime. Again, I read these goddamn books. Don't ask how he know this. You don't want to read it. That's why you're here right now. Because I'm here to help you. Example. You sell a put option with a strike price of 90 for a... let's start over. Example. You sell a put option with a strike price of $90 for a stock currently trading at 100. You collect the premium, and if the stock drops below 90, you'll be obligated to buy the stock at 90. If it doesn't, you keep the premium. I said rising. That says risk. Boy, you can't read. Risk of using put options. You have loss of premium. Time decay, which is the theta, something that I named earlier. Limit time horizon. Complexity of strategies. Now, we're going to break them all down. Starting with loss of premium. Let's start with the loss of premium. If the underlying asset price stays above the strike price, the put option will expire worthless. And if the buyer loses the premium paid. This is the maximum risk for put buyers. It's the same thing for call buyers too. You can only lose what your premium is. But you can, if you're paying attention to it and keeping track of it, you can stop it at a certain point. Meaning, let's say you put in 100% and you take it drops to 30%. Meaning you're negative 30% from your initial investment. You can take your money back out and reinvest somewhere else or get in at a different strike price. Letting the hawk in. Alright. Time decay. As the expiration data approaches, don't drink tequila and try to explain stuff to people because you'll be reading all kind of messed up sometimes. Time decay. As the expiration date approaches, the value of the put option decreases due to time decay, which is the theta. Mind you, we'll go over Greeks in another video. If the stock doesn't move significantly in the anticipated direction, The put option may lose value even if the stock price is slowly moving toward the stock price. Here's why. Because before I'm going to use a swing trade. A swing trade is anything outside of a day. Let's say you get in on Monday and your expiration date is Friday. Let's say the current stock price is $100 and you think it's going to go to $95 in the matter of that week. Let's say it's went from $100 to $97. If you don't take your money out, which is technically a small profit, before Friday, you're going to end up losing your entire premium. Simple as that. Don't believe me? Go test the shit out. Here's how you can go back test for free. Paper trading. Use Webull. Thinkorswim, TD Ameritrade, E-Trade. They got paper trading. You think I'm bullshitting? Go test it out yourself. Carry on. Limited time horizon. Put options have an expiration date, so let's call options. And if the stock price doesn't move below the strike price within that time frame, the option expiration is worthless. This limits the time the investor has for the stock. This limits the time the investor has for the stock to move in their favor, which is why I keep stressing you want to buy. If you're going to pay for it, you're going to pay the premium for it, please buy time. I'm giving you a fucking cheat code, 6 to 12 months. Don't go 1 week. Don't go if you do. Man, I promise you, if you don't have the skill set, the charting data, the fundamental analysis correctly, please don't do a day trade. Please don't do a swing trade. Please do a leap option. Because any other way, you're going to fuck yourself over. And I can't help you. No one can help you. You're going to say somebody's bullshitting you. And no, that's your ass not listening. And it's your fault. Limit time horizon. Okay, I read that. Complexity of strategies. Okay. Some put option strategies, such as spreads, involve multiple moving parts and can be complex for the novice investors. To execute properly. Additionally, that had to be a word that I got out of the goddamn book. Novice. For novice investors to execute properly. Okay. Additionally, they often require margin accounts and a deep understanding of the market. Never, I mean absolutely never, do margins with your broker. That means your ass is asking them to loan you the money so that you can do your trades. Now, if you lose that money, you owe them just like you will a credit card. And they're going to be a little bit harsher because that's like you're fucking with the IRS. You're fucking with you can't just bankruptcy write that shit off. Like, I mean, you probably could, but them folks gonna want their money worse than the goddamn credit card company. Credit card company is in that business. They're not in that business. They just know they can make money off the people that don't know that way. You don't know, you don't know. Conclusion. Put options offer investors powerful tools for hedging against potential losses, speculating on a declining stock price, and managing portfolio risk. They provide a flexible way to profit from bearish market conditions or to protect a portfolio from downside risk without requiring large amounts of capital. However, they come with risks such as the potential loss of the premium and theta, aka time decay. Understanding these dynamics along with various strategies such as the protective puts and put spreads is crucial for successfully using put options. Man, listen to me. put options, call options, stock options, stocks buy and hold. That's all you need to profit in today's economy and today's market. Now, it's your boy Jab. I'm going to keep telling you, I do not need your funding. The market pays me. I don't need your money. But I do need your support to get this out to more of our people. When I say our people, I don't mean just black people. Anybody that's willing to learn any of this information. You be black, white, Latina, bro, I do not care what you is and what your ethnicity is. You want to learn this shit? We're here. I'm trying to learn it more. You're trying to learn it more. Let's learn this shit together. It's your boy Jab from Prolific Learners Network. Get at me. Leave your comments. Like this. Subscribe to my channel. Just get at me. Help me help you. Let's get into them rooms together. You going to work every day. I done went to work every day. I go to work every day. Bro, let's learn how to make our money work for us. Until then, I'm going to catch you.